Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Nebius Group.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Yeah, and before we really get into the weeds today, I just want to quickly mention a tool for all the investors and traders listening.
Oh, right, VIP Algos.
Exactly. So if you want some help reading your trading charts a bit more clearly, you can check out VIP Algos through the link below in the description.
It's a solid setup.
It really is. It's a TradingView indicator suite that basically just gives you a cleaner chart workflow. It has these visual buy and sell alerts, trend direction tools, and it maps out support and resistance zones for you.
But we do need to put a quick disclaimer on that.
Yes, absolutely. VIP Algos is an educational chart analysis tool only. It is not financial advice, it does not place trades for you, and it definitely does not guarantee profits. Trading involves risk, so always manage your risk and do your own research. And just so you know, that link in the description is an affiliate link, so we may earn a commission if you use it, but at no extra cost to you.
Okay, so let's unpack this. We are focusing entirely on Nebius today.
Yeah.
And the central tension driving this stock right now is honestly, it's one of the most fascinating standoffs in the entire market.
It's intense.
It really is. On one side, you have this immense volatility fueled by heavy pressure from short sellers.
Right. They're betting aggressively against the company's near-term viability.
Exactly. But then on the flip side, Nebius is sitting on a $50 billion AI infrastructure backlog.
And they have direct financial backing from Nvidia.
Which is massive. So our mission today is to decode the reality here. Like, are we staring at the ultimate bear trap, ready to violently squeeze the short sellers? Or is this just a cash-burning illusion about to dilute its shareholders into oblivion?
It really is the ultimate tug-of-war. The short sellers are just entirely fixated on the cash burn right now.
Yeah, the negative margins today.
Right. They see a company spending money way faster than it can print it. But the bulls, and frankly, the institutional heavyweights, they're looking past the current balance sheet.
They're looking at the infrastructure grid of tomorrow.
Precisely. They recognize that whoever owns the concrete and the power lines, well, they dictate the terms for the entire AI industry.
So, all right, let's move into the wealth building context.
Yeah, that gives us the bigger picture. Now let's look at the fundamentals. Because to understand Nebius, you have to realize they are a pure play AI infrastructure landlord.
Right. They aren't building the consumer chat bots.
No image generators either. They're literally pouring the digital concrete.
Which brings up a critical question for you listening right now. What is your actual portfolio timeline?
That is the big question.
Because if you're looking for a quick quarterly pop, this stock will likely test your sanity.
Oh, absolutely. Capitalizing on this global AI compute demand cycle, that's a multi-decade story.
Not a swing trade.
Exactly. Not a swing trade at all. It requires an investor who is willing to endure the near-term volatility.
And the scary headlines.
Yeah, the scary headlines and the current cash burn, just to see that eventual valuation reset. The demand for raw compute power is not a fad. It is structurally accelerating, and Nebius is maneuvering to be the landlord that every other tech giant is forced to pay rent to.
See, it's easy to sell a multi-decade visionary story, but when I look at the fundamentals right now, the sheer scale of their growth is, well, it's almost hard to process.
The numbers are staggering.
Yeah, in the first quarter of 2026 alone, Nebius generated $399 million in revenue.
Which is a massive 684% increase year over year.
It's the absolute definition of hypergrowth.
It is. And if you isolate just their AI cloud revenue, it expanded about 841% during that same period.
Wow.
And management has firmly set their full-year guidance at $3.0 to $3.4 billion. But, the revenue numbers are just a symptom of their underlying moat.
Because in the AI arms race, a moat isn't just proprietary software anymore.
No, it's physical. It's unyielding infrastructure.
And specifically, it's about controlling bottlenecks, which Nebius is doing by securing two critical choke points.
Starting with power.
Right. They have over 3.5 gigawatts of total power capacity. Let's just contextualize that for a second, because 3.5 gigawatts isn't just some big number on a spreadsheet.
No, that is the equivalent of powering several major metropolitan cities.
Exactly. Securing that kind of grid access involves years of permitting, building out substations, navigating all the regulatory red tape.
You can't just spin that up overnight.
You really can't, which is exactly why they've secured that $50 billion contracted backlog, anchored by massive players like Meta and Microsoft.
You're spot on regarding the physical difficulty of securing power. And the second choke point they control is the hardware itself, the GPUs.
Right, the Nvidia connection.
Exactly. Nvidia holds a direct equity stake in Nebius and is actually committed to investing $2 billion in the company by 2030.
That's a huge strategic backing.
It is. And it guarantees Nebius priority allocation of advanced chips. When rival cloud providers are fighting tooth and nail over limited chip supply.
Nebius basically gets to skip the line.
Right. Because Nvidia needs environments that can actually run their hardware efficiently, and Nebius provides exactly that.
Okay, so here is where my skepticism kicks in a bit.
Mm-hmm.
Because the balance sheet tells a much darker story.
I knew we'd get here.
I mean, hypergrowth and Nvidia partnerships sound incredible, but the company has negative margins right now.
They do.
They have negative free cash flow. Their capital expenditures are vastly exceeding their operating cash flows.
Yeah.
To me, this feels like a mall developer offering free rent to anchor tenants, like huge department stores, just to get the building constructed and legitimize the property. At what point does this actually make money?
It's a very fair challenge, and honestly, the mall developer analogy is pretty apt. They are absolutely taking hyperscaler contracts at low, or in some cases, negative margins right now.
So they're losing money on these deals.
Short term, yes. But you have to view this through the lens of a calculated land grab.
Okay.
By securing those foundational contracts with the likes of Meta and Microsoft, Nebius guarantees total utilization of their infrastructure. They lock in revenue visibility for the next decade.
So they deliberately take a hit on margins now to own the real estate forever, basically banking on the idea that they can squeeze their tenants later.
Precisely. Just look at the physical reality of the broader market right now. North American data center vacancy rates have collapsed to a historic low of 0.9%.
Wow.
And in prime hubs like Northern Virginia, it's down to a desperate 0.3%.
That's effectively zero available space.
Exactly. So once Nebius has the infrastructure built, the power secured, and the servers humming, the pricing power shifts entirely in their favor.
Right, because when those initial low-margin contracts expire, the clients literally have nowhere else to migrate to.
The switching costs would just be astronomical, so
Yes.
Nebius will be able to expand margins significantly.
Okay, that gives us the business picture. Now let's move to the catalyst timeline.
Right, and catalysts tell us what could change the story. Now let's pivot to the chart.
So looking ahead to the next 3 months, we've got the Q2 2026 earnings coming up in August.
Yeah.
And I imagine the market isn't going to care much about bottom line profits yet. The critical metric has to be the conversion rate of that $50 billion backlog.
Absolutely. We need to see how fast they can turn those signed contracts into recognized revenue. That will be the primary focus for analysts, undoubtedly.
Makes sense.
But we also have to factor in the severe sector tailwinds pushing them forward right now, specifically the Vera-Rubin chip cycle ramp-up.
Let's dig into the mechanics of that, because the Vera-Rubin cycle isn't just, a software update. It completely changes the physical requirements of a data center.
It changes everything. I mean, These next-generation chips run incredibly hot.
Right.
They require specialized, power-dense, liquid-cooled infrastructure.
Which you can't just retrofit into an old building.
No, you cannot simply take a legacy data center built in 2015, swap out the racks, and run Vera-Rubin chips. The floorboards would literally collapse under the weight of the liquid cooling systems.
Jeez.
And the legacy HVAC systems couldn't handle the thermal output anyway.
So Nebius has an edge here.
Exactly. They are building purpose-built, high-density infrastructure from the ground up. It makes them one of the few landlords actually capable of housing this next generation of compute.
That structural advantage is super clear. But there is also a highly speculative rumor floating around that could change their fundamental business model entirely.
Oh, the Eigen AI acquisition.
Yeah.
Yes, this is a fascinating development. There are credible rumors that Nebius, following that Eigen AI acquisition and their recent deal with Clarify, is actually building a full-stack inference platform.
Let's translate what that actually means for the valuation. Because right now, Nebius is basically leasing out bare metal servers.
Right, it's a hardware rental business.
But if they successfully move to offering a full-stack agentic AI platform,
They transition into a fully managed software-as-a-service model.
and as any tech investor knows, the market assigns vastly higher valuation multiples to SaaS companies than it does to hardware landlords.
It would be a monumental catalyst for multiple expansion. It takes them from being just the concrete foundation to being the entire operating system for enterprise AI.
But as an investor, you have to ask yourself a hard question here. Are these catalysts already fully priced into the stock?
Right.
I mean, if every institution on Wall Street knows about the $50 billion backlog, the liquid cooling requirements of the Vera Rubin cycle, and the Eigen AI rumors, does a simple revenue beat in August actually move the needle?
It's tough to say.
Because if the profit margins remain deeply negative, the market's patience might just wear thin. They might demand a clear path to profitability sooner rather than later.
And that tension between future catalysts and current cash burn is exactly what is driving the volatility on the chart right now.
So the chart gives us price structure, but what does market sentiment look like?
Well, when you look at the technical structure first, Nebius is retreating heavily amid rising short interest. There is just immense psychological pressure on the stock.
Yeah, short sellers aggressively targeting top neocloud companies.
Exactly, to capitalize on that exact impatience you just described.
The short sellers are piling in, but they are doing so against a company with a $50 billion contracted backlog and continuous capacity expansion announcements.
Right, like they just recently announced a £1.7 billion investment in their UK infrastructure.
Which creates a very rigid fundamental floor under the stock. That kind of capital deployment isn't just noise.
No. And it creates the perfect conditions for a classic bear trap.
Oh, definitely.
The downward momentum is fierce, but if the stock can manage a technical breakout above its recent resistance levels, the resulting price action could be incredibly violent.
Right, because of the high short interest.
Exactly. A breakout would trigger a massive short squeeze. It would force those bears to aggressively buy back shares to cover their positions, which in turn fuels exponential upward momentum.
And if we zoom out and look at the broader historical context, the short-term noise kind of contradicts the long-term trend.
Oh, for sure.
Over the past decade, this stock has historically generated an average annual return of 28.14%.
It's impressive.
It remains in a very clear structural uptrend. But, and this is crucial, technical patterns show probabilities, not certainties.
Right.
A fundamental floor can still break if the macro environment shifts.
Totally.
Which is exactly why disciplined traders use charting tools to map out precise support and resistance zones. You need an objective plan for where the key levels actually are when emotional volatility takes over.
Having those technical levels mapped out is essential, especially when dealing with a battleground stock where the market sentiment is so completely fractured.
Fractured is the perfect word for it, because when you look at the retail sentiment, it feels overwhelmingly bearish.
Yeah.
The short-term options market is heavily skewed toward puts, and it's fueled by fears over the high valuation, the suppressed margins, the relentless cash burn.
You can't even open a financial news portal without seeing headlines explicitly warning investors to avoid Nebius stock.
Exactly, but then you cross over to the institutional side, and the perspective flips entirely.
It's like a different world. The smart money is structurally bullish. Take Bank of America, for example.
Right.
Analyst Tal Liani recently boosted Nebius's price target from $240 to $280.
Which is a huge jump.
It is. And his reasoning wasn't just based on raw compute demand. It was tied to their growing strategic technology stack. Like Nebius recently unveiled their AI Cloud Aether 3.6 platform.
Which integrates an AI infrastructure assistant.
Yeah, and dramatically strengthens their developer tools.
Which goes right back to that SaaS transition we discussed earlier. Aether 3.6 makes the Nebius ecosystem incredibly sticky.
Exactly. Developers build their workflows directly into those tools, making it deeply painful to ever migrate to a competitor.
So the institutions see the product evolving from a commodity to a full ecosystem.
Yes. And beyond Bank of America, we simply cannot ignore the ultimate institutional cosign here. Nvidia committing $2 billion in equity by 2030.
Right.
I mean, Nvidia possesses the most comprehensive vantage point of the entire AI industry. They know better than anyone else on the planet where the physical bottlenecks are located.
Which really forces a very uncomfortable deduction for the retail bears.
Yeah, it does.
Like, does the short-term retail options market genuinely believe they know something about AI infrastructure that Nvidia and Bank of America don't?
Probably not.
I mean, when the primary architect of the global AI revolution decides to park $2 billion in this specific company's equity, betting against that thesis requires an extraordinary level of confidence.
That sentiment picture is useful, but we still need to talk about the risks.
Yeah, because even with Nvidia's backing, we have to look objectively at the math. The balance sheet right now presents a very real existential threat.
The cash burn is intense.
Let's lay that math out clearly. Nebius currently sits on a cash pile of approximately $9.3 billion.
Which, in a vacuum, sounds phenomenal.
Right. Until you look at their updated guidance, which projects full-year capital expenditures at a staggering $20 billion to $25 billion.
Yeah, the gap between their current liquidity and their required spend is enormous. It's a $10 to $15 billion shortfall.
And a shortfall of that magnitude means only one thing. They must tap the capital markets.
You have to raise money, and soon.
Exactly. And doing so at their current depressed valuation introduces severe risk for current shareholders. We are talking about the very high probability of brutal equity dilution.
Flooding the market with new shares.
Right, which crushes the value of existing holdings. Or, alternatively, they take on a suffocating debt overhang in a high interest rate environment.
Which would completely destroy their future cash flow modeling.
Exactly.
The dilution risk is definitely the most immediate threat. But the secondary threat is the margin compression execution risk.
Explain that one.
Well, we spent a lot of time discussing their calculated land grab strategy, right? Yeah. Taking those low-margin hyperscaler contracts to guarantee utilization.
Right, banking on future pricing power.
Exactly. The entire premise relies on future pricing power. But what if power costs spike dramatically due to grid constraints before that pricing power kicks in?
Oh, wow.
Or what if the cost of AI compute commoditizes much faster than the industry expects?
If the economics of compute flip, those foundational contracts suddenly become liabilities.
Exactly. Those long-term, low-margin agreements could transform into concrete blocks, dragging the company's balance sheet underwater, rather than stepping stones to profitability.
Because they are contractually obligated to provide the power and the compute.
Yes. And if their underlying costs surge, the cash burn will accelerate to a point where even Nvidia's backing might not be enough to plug the hole.
Okay, so with everything on the table, what's the final verdict? We've got the $50 million backlog, the Vera Rubin cycle, the short seller pressure, and that looming $15 billion capital shortfall.
Based on the underlying research, the final synthesis gives Nebius a bullish score of 8 out of 10. The fundamental stance here is that Nebius is the premier, pure-play AI infrastructure landlord on the market. However, this is strictly a high-risk, high-reward play.
It requires a multi-year investment horizon.
Absolutely. The primary upside driver is their unparalleled ability to leverage scarce power resources and priority GPU allocations into high-margin cash flows, operating under the assumption that global demand will continue to vastly outstrip supply.
But remember, this rating is for investors who are entirely prepared to stomach extreme short-term volatility.
And the very real impending threat of near-term dilution.
Exactly. If you are a risk-averse investor looking for stable, immediate free cash flow, you need to tread very carefully here. And as always, this is not financial advice.
No, we are simply exploring the data and the mechanics of the trade. You have to make your own decisions.
And if you want a cleaner, more objective way to read trading charts amidst all this volatility, check out VIP Algos through the link below in the description.
Yeah, VIP Algos is a TradingView indicator suite featuring visual buy and sell alerts, trend direction tools, support and resistance zones, and TPSL planning areas.
It can really help make complex charts easier to scan and map out. But remember, it is still only an educational chart analysis tool.
Right. It is not financial advice. It does not place trades for you, and it does not guarantee results. Trading involves risk, so always do your own research and manage your risk accordingly.
And again, this is an affiliate link, and we may earn a commission at no extra cost to you. Now, before we wrap up today, I want to leave you with one final thought to mull over. Something the market isn't entirely pricing in yet.
Well, the power grid issue.
Exactly. We spend all our time debating whether Nebius has enough cash to build these massive 3.5 gigawatt data centers. But what happens when these AI facilities start requiring the same amount of electricity as entire sovereign nations?
A scary thought.
At what point do governments step in, look at their strained national power grids, and decide that heating homes and powering hospitals takes precedence over training large language models?
That is the ultimate black swan for the AI infrastructure trade.
Right. It isn't a lack of capital or a lack of chips. It's the geopolitical risk of the power grid itself being nationalized or heavily restricted. If the landlords aren't legally allowed to plug their buildings in, the entire ecosystem halts.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.